Hello. So in this video, we are going to learn about a free strategy. It's a passive strategy where you invest in index funds in India as well as in the US. But there is a small twist via which we will be able to reduce the risk by over 80%. So we were able to reduce the risk in 2020, the crash that came with coronavirus, by around 50%. And using the same strategy in 2008 financial bubble, we were able to avoid it by approximately 96% or 80%, around that much. So I'm going to show you exactly how, but before that, let's first decide on the allocation part. Okay, this is a educational video. This is not a investing advice. Please do not take this as an investing advice. It's an educational video. Please see to it from an educational perspective only. Okay, so this is a hypothetical situation where we are investing in Nifty Index Fund. This is the allocation part. We will be allocating around 25%. Nifty Next, which is the next 50 stocks, around 25%. So we are investing total, like Nifty 50 and Nifty Next, it will be around Nifty 100, right? The top 100 companies in India. Next, Nifty Mid Cap 150, 15% allocations, and S&P 500 is the US 500 companies, top 500 companies in the US. S&P 500, we will be investing 30%. And Nifty Small Cap 250 companies, it's around 5%. Small Cap, we are just allocating a little less. So what you see is in India, ultimately, we are investing in 500 companies. How 500 companies? See, Nifty 50, 50 companies, Nifty Next 50 companies, Mid Cap 150 companies, and Small Cap 250 companies. So total 250 plus 250, 500 companies. So 500 companies in India. And S&P 500 is equal to like the 500 companies in the US. So a total of 1000 companies. If you invest in this allocation, you are ultimately investing in 1000 companies. Okay, that's a lot of diversification. So I have calculated the data manually with this allocation till 2012. So this on the top columns, just check this. If 2020 with the allocation, we had a 17% return. In 2019 we had a 14% return. 2018 minus 3% return. 2017 32% return. And when you compare it with Nifty, it's more or less the same, but we have a little bit of a difference. Like in 2016 Nifty gave us 3% return, we had a 6% return with our portfolio. 2015, if you have invested only in Nifty 50 index fund, you had a minus 4% return. And if you have invested in the whole package of all the 1000 companies in this allocation, you had a positive return of 0.8%, which is 1% positive. 2014, it's more or less the same, 31%, 32%. Then 2013, you had 6% with Nifty, but overall 1000 companies gave us 12% return. And 2012, it was almost the same, 27%. But if you see the last 8 years, okay, on average, you had average is around 15%. This is not a CAGR return, it's just an average, okay? Basic average return of 15%. And if you know this, Nifty 50, if you have invested in Nifty 50 for the last around 20 years, you had an average return of more or less 15%. Okay, if you just take a normal average, it's 15%. So this is also 15%, but if you are investing in this allocation, you had a little bit of diversification, what you call it. So 1000 companies versus just 50 companies. Or if you can say 30% if you're investing in the US, 70% you're investing in India. That's a little bit of diversification. And S&P 500, you don't have to go to the US or make an account with a broker in the US. You can do it with Indian brokers as well. So there's no tax implications. It's just taxed as debt funds. So that's pretty easy right now. So for S&P 500, for me personally, I'm investing a little bit on S&P 500. I'm investing very less, not 30%, obviously, around 3% or 5% maybe of my portfolio. And I am investing through, I guess, Motilal Oswal. I guess I have to check it though. So yeah, that's a very passive allocation. So you can check it with various brokers and mutual funds in Value Research or Money Control. You'll find it. Anyways, So there is a strategy, okay? How can we reduce the risk? This allocation is fine. Now let's think about the risk portfolio, okay? So this is what I've come up with. This is a simple strategy, okay? So you are going to check the previous year return. Previous year return, you're going to check it. And if the previous year return is between 10 to 15%, okay? If it's between 10 to 15%, then the equity and debt allocation should be around 50-50%. So if you have 100 rupees and last year the return of Nifty was say around 11%, so this year 50% I'm going to put it in debt funds. Debt funds can be a mixture of corporate bonds, low duration funds, liquid funds. You can just mix it up a little bit, and that's debt funds. And the equity portfolio, you can just put it only on Nifty, or you can just make a total package of all the 1,000 companies. So right now, that's the allocation part, okay? So if it's below 10%, we are going to allocate 75% in equity and 25% in debt. But if the return of Nifty, or if I'm only checking the return of Nifty right here, okay? If the return of Nifty is say above 15% in a particular year, so what we are going to do is we are going to book some profits. We're going to take out some profits, and then we are going to invest 25% in equity and 75% we are going to keep it in debt funds, okay? So what happens with Nifty is you do not see a normal return of 15% year after year. What you see is sometimes you will get 30% return, sometimes you will get minus 4% return, then again you will get 25% return, again you will get a 10% or 9% return. It will keep going up and down. So that's what we are trying to take advantage of. So I have done a test in this below. I have checked if we have invested rupees 100, okay? Just take rupees 100, invest it in Nifty. Simple investment in Nifty, don't do anything else. After 20 years, I have a 20 years data, okay? After 20 years, this 24 number column, row number 24, this 100 rupees would have become, after 20 years, 938 rupees. Okay, in 20 years, you would have had a return of around nine times. But if you have invested in this strategy where you, without considering the tax factor, okay, I'm not considering the tax factor here. Without considering the tax factor, if you have invested in this strategy where you keep the allocation 25-75 or 75-25 or 50-50 based on the previous year return, and you keep changing it once every year, say on January 1st maybe, or December 31st, you keep changing that allocation, then this 100 rupees would have become 1269 rupees. It would have given you more return than investing in Nifty, just Nifty, okay? And do you know what the best part is? The best part is in 2008, the crash, I'm going to show you something. This area, Nifty has given a negative return of 52% almost, okay? 52%. So it wiped out 52% of your portfolio in 2008 crash. But with this strategy, you had a minus 7% return, just minus 7% compared to minus 52%. See, and in 2020, we can't see the negative return right here because the market recovered within a period of 1 month basically, but Nifty went down 40%, minus 40%. And this during this period, in 2020, we were at a allocation of 50-50% with this strategy. So we had a negative of hardly minus 20% max to max. So even here you have reduced your risk by 50%. In year 2008, you have reduced your risk by over 80-90%. So if you compare this and 2001, you have reduced your risk by say minus 16% in Nifty, you had a minus 10% with this strategy. Year 2000 was the dot-com bubble. Nifty had a minus 14% return or minus 15%. You had a profit of 2%. So we were able to like reduce the risk using def component and changing the allocation year after year. So Nifty, if you see the 100 rupees, see Nifty has become 85 rupees, then 71 rupees, 73 rupees. At the same time in the strategy, it has become 102 rupees, 91 rupees, 96 rupees. And slowly, if you keep seeing, till 2007, Nifty has this 100 rupees has become around 400 rupees, whereas with our strategy 100 rupees has become just 275 rupees. But in 2008, the crash, 51% down, this 414 rupees has become 200 rupees. But our 275 rupees has just become 256 rupees. There's little volatility. Okay, so when this has happened, now our strategy, and when Nifty went up like 75%, our strategy went up 58%. Not much, it's okay. So Nifty from 200 has become 351 rupees. Our strategy from 256 has become 400 rupees. And hence, slowly and slowly, by just getting rid of this negative years, like 2011, Nifty went down 25%. We went down hardly 0.15%. That means you didn't lose money at all. Okay. So from 414, it has become 300 rupees. But our 450 rupees stayed at 450 rupees. So even while investing, you need to understand there's always some emotion when market goes down by 20, 30%, 50%. And if you can just avoid those years or at least reduce a little bit, you'll be more comfortable investing. And by the end of your investing career of say 10, 20, 30 years, if you're getting more return using a more secured, stable strategy than just simply investing in Nifty, then why not opt for it? So here's a very simple strategy that I've shown you, and you can of course make a lot of changes here with mutual funds, maybe with different kinds of debt funds, maybe. So you can make a lot of different components, you can add gold to it, you can make a different strategy altogether. But this is just a basic concept that I'm showing you, that with the help of a little bit of diversification, you, by avoiding certain years where the market goes down, even though you do not earn a high return like 2007, Nifty gave a 54% return, our strategy gave a 19% return. But next year Nifty went down 51%, we went down just 7%. So even though we didn't earn a lot of return in 2006, say 39% and 15% returns. So in 2006 we had very less return compared to Nifty. 2007 we had very less return compared to Nifty, but still we made more money. Starting here till here we made more money by just avoiding certain market crashes, by just avoiding certain days, certain months. You can really be more comfortable investing. And that's the basic and the takeaway from this video. To understand, if you get a little bit of less return, it's fine, but opt for asset allocation, a little bit of diversity in your investing. And even if you earn a little less in a few years, sometimes that will help you to avoid a lot of big losses. Okay, so take that as a takeaway. So this was a free strategy from Money Making Monk on Nifty Index Investing and S&P 500 Investing. And that's all for now. If you have any queries, do ask me in the comments below. And please like this video. It's gonna help me a little bit to the channel to get some visibility on YouTube. I really appreciate your time. Thank you so much. And if you have not subscribed, please subscribe to this channel. Take care. Bye.